the last episode, we covered cash, profit, and break even. But we didn't tackle how you could actually show this information to people who may want to see it. And in this episode, we're going to tackle exactly that. How businesses actually present financial information in a way that is both relatively standard and understandable. There are two key financial statements that you should know about. The first is the profit and loss account, which shows how much money the business made or lost in any given period. The second is the balance sheet, and that shows what the business owns and owes at any specific point in time. You'll find that these two financial statements will be used by almost all businesses, and they cover very different things, but you'll find they're both often as important as each other. Financial statements are an important tool for entrepreneurs, and they're typically drawn up by accountants, whose job it is to maintain, inspect, and analyse financial information. And whilst accountants will normally be the ones preparing these financial statements, as a budding entrepreneur, you should definitely have a basic understanding of them. A profit and loss statement shows the financial performance of a business over a period of time. It normally covers a whole year, but could also be drawn up for other periods of a number of days, weeks, or months. Let's look at a really quick example of building a profit and loss statement using the largest car washing business. Elijah is preparing his own profit and loss account, and he starts by recording his sales. He's looking at his profit and loss account for a 1 month period only. That's from the 1st of May until the 31st of May. And he wants to see just how profitable his business was in that period alone. In May, Elijah washed 20 cars and was paid £8 to wash each one. He calculates that his total revenue is therefore £160. He inserts this sales number at the very top of his profit and loss account. He then goes on to record his costs. He starts with his variable costs, which depend entirely on how many cars he washes. For Elijah, the variable costs are the shampoo and the super slick car wax that he uses on his customers' cars. At the start of May, Elijah had a full 10-metre bottle of shampoo, but at the end of the month, he'd used half of it. On that basis, he worked out that he used 5 litres or half the bottle, and if the entire bottle cost him £24, he calculates half the bottle cost him £12. He records this variable shampoo cost in the profit and loss account. He does the same calculation with the wax and records £18 of variable cost of wax in the profit and loss account for the month of May. Shampoo and wax are the only variable costs that Elijah has, and that allows him to calculate what is known as his gross profit. Gross profit is the total amount of sales minus the variable cost of the sales, and it's always shown on a profit and loss account. Elijah's gross profit is £130, calculated as his £160 of sales less the £30 in variable costs from his shampoo and wax. So having calculated his gross profit, which is the profit after variable costs, Elijah now means to record the fixed costs on the P&L. He's tried to keep these as low as possible on purpose. Over the course of the month, Elijah paid his mate Tyra and £40 to help him wash the cars. That represents a fixed cost, as he paid Tyra a flat rate, and it wasn't based on the number of cars that he helped him wash. Elijah's final costs are for the buckets and cloths. He bought these for £24 at the start of the year, but given they're going to be used throughout the entire year, he decides to spread the £24 cost equally over 12 months. That's £2 a month. So he records a cost of £2 in May for the buckets and the cloths. Elijah is using accrual accounting, and by doing so he's spreading certain costs of the business over the entire period to which they relate. Elijah has input all of his data into his profit and loss account and now needs to calculate his monthly profit. Sales were £160, which after variable costs left a gross profit of £130. From that, he deducted variable costs of £40 and £2, which resulted in a net profit to the business of £88 for the month of May. Elijah is seriously chuffed, and with his profit he goes to celebrate with his mum and some of the very best chocolate cream cake. And so that's what a P&L, or profit and loss account, is all about. It's a statement that shows a business owner and others the profit or loss that they'd made in a particular period. And from the profit and loss account, you can always do quite a bit of analysis. The most important analysis that people often do from a profit and loss account is look at what are known as margins. There are lots of different margins to consider, and we won't be covering all of those now. But for Elijah's P&L, you can calculate the gross margin and net margin as a percentage of sales. His gross margin is calculated as his gross profit of £130 divided by his £160 of sales, which is 81%. And his net margin is calculated as his net profit of £88 divided by the sales of £160. And his net margin is 55%. And that's pretty good as well. Margins are a key bit of information that most entrepreneurs will want to keep a close eye on, and they're great for indicating the financial health, or otherwise, of your business.
Look at our profit and loss every day. We have a brilliant accounting system called Xero, and I literally tap into it every day. But I suppose we look at it more formally once a month.
Generally, I'll review a P&L on a monthly basis, but generally have a much closer eye on cash on a weekly basis, or even shorter time frames if needed.
We look at our profit and loss on a monthly basis, but then we'll have regular meetings with accountants on a quarterly basis.
I'll review the profit and loss every month. We'll always look at sales on a weekly basis, even a daily basis, but our P&L we'll look at on a monthly basis, and we'll look at the P&L for that month, but also for the year we've had, and also the profit and loss against last year, because we'd like to see how this April has gone against last year's April.
We look at our profit and loss account on an annual basis.
So we've just covered the first main inside the financial statement, which was the profit and loss account. And now we move on to the second main financial statement, which is known as the balance sheet. A balance sheet shows two key things. Firstly, what the business owns, known as assets, and secondly, what the business owes, and those are known as liabilities. Let's take a look at the assets, which are always recorded on the top half of the balance sheet. Assets are divided into two categories: fixed assets and current assets. Fixed assets are assets which are used for the long term within the business, and current assets are normally used day by day. In Elijah's business, his main fixed asset is his ladder, if he thinks it's going to last for the long term. His current assets are the cash he has in his bank, the buckets, the shampoo, the wax and the cloths. All of these assets, both the fixed assets and the current assets, are recorded at their cost on the balance sheet. Elijah's ladder, which is his only fixed asset, is placed on the balance sheet. The £40 cost of that ladder will be depreciated over time as it moves through its usable life, and that comes back to the concept of accrual accounting. Elijah's balance sheet will record not only the original cost of £40, but also any depreciation of the asset, depending on what are known as accounting policies up to the date of the balance sheet itself. For this example, let's assume the depreciation is £10, which is the £40 cost of the ladder spread over 4 years. This leaves what's known on the balance sheet as the written down value, or net book value, of £30. Depreciation is something that we will tackle in a future learning series, but for now, just imagine it's the amount that comes off your fixed assets every year that reflects their usage over that period. After the fixed assets have been recorded, Elijah goes on to record the cost of the current assets left, which are £60 of cash, £16 of buckets and cloths, £12 of shampoo, and £18 of wax. that makes £106 of current assets, and when added to the fixed assets, it makes total assets of £136. Elijah's well pleased with having £136 of total assets. And then, having looked at the assets at the top of Elijah's balance sheet, he turns to the bottom half, which shows his liabilities. Liabilities are the amounts that Elijah's business owes to other people. The money that Elijah does owe to his mum needs to be recorded as a liability of £100 on his balance sheet. It's a negative number because it's money that he owes. But given that Elijah's got total assets of £136 and liabilities of only £100, he still has net assets of £36, and that means he's the right side of positive. Elijah has got a positive balance sheet. There are some real advantages to having a good understanding of the financial statements in your business and having them prepared regularly. They should provide a clear financial overview of your business and allow you to measure your business's performance as you go along. Having these statements in hand can also be handy for comparing yourself with other businesses. Ensuring they're right is pretty important, as inaccuracies can lead to poor decision making and financial instability.
Well, we haven't really made any mistakes on our financial reporting so far. One of the areas we really look closely on is our stock. Every month we look at our stock, because if our stock's gone up or down, we know how much money we spent on ingredients. And it's an area we focus on quite heavily, because if we've used more ingredients than we thought we'd use, then our profit would be lower than we expect it to be.
There haven't ever been any big mistakes with our balance sheet because I've never prepared them myself. I didn't trust myself, so I outsourced it very early on.
No, because we realised straight away that not having the right CFO in place was one of the biggest risks we'd face in our sector. So we made sure we got the right person.
Based on some really high-level estimates, why don't you take a look at creating a forecast profit and loss account for your own business? What would your sales be? What would your costs be? What would the profit look like after the first year? Try to estimate your future sales for each of the first 12 months. And alongside that, think about what your costs are likely to be. Why not push the envelope and try to create a forecast profit and loss account for your business in its first year? We've included some great financial statement templates on our platform, so if you've got access to that, you can make a quick start with your profit and loss forecast. There's obviously a load more to understand about profit and loss statements and balance sheets, and also the interaction between the two. But hopefully, having watched this episode, you'll be aware of both the profit and loss account and the balance sheet, what both show, and how they're both created. And now that we've finished episode 10 or financial statements, we're gonna move on to episode 11, where we explain exactly what makes a good business.